great company. Unfortunately, none of that matters right now. Farfetch is a company that's losing a ton of money, which you know we don't like. And it's got no clear path to profitability, which you know we disdain. At least so far.
Welcome back to Strongman Personal Finance, everybody. You know, Jim Cramer gets a lot of crap from retail. You know, he says stupid stuff. He usually times the bottom of every stock perfectly by telling you to sell it. And he's kind of a clown. But he's also entertaining. And in this scenario about this specific stock, I think Jim Cramer is actually correct. Welcome back, everybody. Let's talk about Farfetch Limited Class A shares. So I have a paid video. Somebody paid me to do this, and I feel like a hero making this video right now. And there's two particular quotes that I want to highlight. The guy that sent me this request, I'm not going to name his name, said, I have roughly 28,000 shares at an average of $4.70 per share. So if we do the math, he's got roughly a cost basis of $131,600. Now, I have no idea how wealthy this guy is. Maybe he's a multi-billionaire, okay? I hope he is, because if you have this much invested in one stock, you're a madman. You made a huge mistake. If you're an average working stiff and this is your portfolio, this is a YOLO, and it's a very dangerous YOLO. This stock could potentially go up, but as we're going to see, there's some big problems with this company. And to put $131,000 into it, that scares me, okay? Another quote is, I'm down $50,000 almost at the moment. Now, if we look at the stock now, it's currently trading at $2.61. That is an enormous loss. Now, people give me crap for like Alibaba and whatever. Alibaba was a very small part of my portfolio. I did not put $131,000 in Alibaba. You have to limit your speculative investments. You cannot be putting this much money into individual stocks. Even companies that are profitable, it doesn't matter, because this is how you could destroy wealth. Imagine losing 45% of your wealth in a day. In a day. This stock dropped 45% on the close on August 18th, 2023. Now, I have no clue where this stock's going to go. I'm not saying, oh, don't sell it. Because maybe this stock will 20,000x and you'll get all mad at me if I tell you to sell it. I'm not telling anybody to buy or sell anything. What I am telling you is you should probably mitigate your risk and not put such a huge position into an individual stock. Now, if you want to buy a broadly diversified ETF, sure, okay? 98% of my portfolio, probably 99%, is in one ETF. And I'm not worried about it. This is crazy, okay? Here's why I don't like this stock. So it went up massively during the clown market, okay? Like, it went from, where was it before the pandemic started? In the $10 range, $10 range. It went up all the way to $73, was probably hyped up by a bunch of people. And now it's crashed all the way to $2.61. Let's go ahead and look at the financial statements, okay? Without even talking about what this company is yet. We're going to look at the financial statements, and we're going to see that there's a lot of big issues with this company. Now, you would think a company that, you know, is so highly priced and it's so unprofitable that they would have insane revenue growth. But at this point in time, their revenue growth is not doing that well. There's really nothing positive about this stock. I mean, they have negative net income, like Jim Cramer said. They're very unprofitable, and they really have no path to profitability. And to be perfectly honest, I don't see how this stock will ever become profitable. Maybe by some miracle it will, but it's going to take a long time before this company makes money. Check out the pinned comment below and join our Discord community, where you can ask me questions directly via text, and if you sign up for the highest tier, you can actually meet me in person every 2 weeks. So check out the pinned comment, join the Discord community, and let's make some money with index funds, of course. Cheers! And a company that doesn't make money, if they're not making money, they have to get money some other way. How do they do that? They borrow it, number one, or they give out shares and dilute the shareholders. That's how companies make money and survive. So let's go ahead and look at the revenue, okay? So we can see revenue is not, I mean, it's grown since 2017, but look at the recent growth in revenue. It's not there, okay? The revenue is not growing that well. Like, that's not good, okay? Let's go down and look at their margins. So their gross margin has been decreasing. This is their profit from the service they provide. Their gross margin is down. Their operating margin is massively negative. Their profit margin is massively negative, and they have a negative free cash flow margin. Shares are being issued at a steady pace. Their share count is going up. So you as the investor, you're not making profits and you're getting diluted, okay? This is not good, all right? This is the type of company that scares the crap out of me. Look at the cash and cash equivalents balance. It's going down and down and down and down. What are they doing? They're burning their cash. They're not making money from their business, so they're burning their cash. And what happens when you burn cash? If you run out of it, you go bankrupt, number one, can't pay your bills, or number two, you borrow more, incurring more interest expense, or you dilute the current shareholders. So cash is going down. Total current assets looks like it's $1.4 billion versus current liabilities of $969. So right off the bat, they're not at the point where they're going to go bankrupt, but they're not sitting that pretty either, okay? They have $453 million of cash, and they have $541 million of receivables. Look how much money they owe in accounts payable. This is just bills to vendors. It's almost as much as their cash and receivables as of this date. I wouldn't be surprised if they've issued shares already after the last earnings were released, because they're very low on cash and cash equivalents. They have current debt coming due of $87 million and then some other current liabilities. Now, look at their long-term debt. They're packing on long-term debt, and, I mean, they could be using that to buy capital expenditures, to be buying capital equipment, but I have a feeling they're probably using this debt to just finance their operations and survive, okay? So their long-term liabilities are $1.9 billion, and their long-term assets are $2 billion. So, oh man, this is scary. Look at this. Look at their goodwill and intangibles, okay? The vast majority of their long-term assets are intangible assets, assets you cannot touch. As a matter of fact, 75% of their long-term assets are in intangible assets, and they still have real debt of $1.4 billion that they have to pay. So if you look at if you exclude their tangible assets, they're massively intangible assets, they're massively underwater. This company is not doing well, okay? Now, this guy, I think, wants to keep buying the dip. I'm not going to tell you what to do. How much, are you a billionaire? Like, why are you so obsessed with this company, man? I'm not saying it can't succeed. You never know. I can't predict the future, okay? I'm just showing you what I see now, and things are not good. They're burning cash from operations. They're losing money in operations. They have to make capital expenditures, maintain their capital equipment. On top of that, they're making acquisitions, even though they're burning freaking money, and they're packing on massive amounts of debt. Like, oh, this is not good. And if you're even wondering what the company is, it's a digital platform where you can buy luxury brands. Okay, you can buy luxury fashion on their website. Now, if we go look at their most recent quarterly report, so we can see some very concerning things here. So for the 3 months ended June 30th, 2023, gross merchandise value, this is the total value of the merchandise transacted on their platform, it barely nudged up. Okay, it's barely increased. Like that, this is not good for a company that's unprofitable and diluting. Their revenue is actually down year over year. Their adjusted revenue, whatever that means, ignore that, is down. Their gross profit is down. Their margins are contracting. Their revenue is contracting. They're unprofitable. They're losing money hand over fist. This is just not good. Okay. So I just really sit down and carefully think, why did you buy this? Do you want to risk all of your money on this? I don't know what percentage of your portfolio this is, okay? I'm not gonna tell you what to do. But this is very concerning to me. I personally would not buy this company. It's not, or if I did, it'd be with like $500 because I'm bored. I want to speculate and be a clown for a little bit. But there is no way in heck I'm putting $131,000 into this company. Jesus, dude. I don't know, man. I mean, anything could happen, you know, if you sell the stock and then it vertical lines, don't get mad at me. But you gotta mitigate your risk, okay? Look at the digital platform, their gross merchandise value's up, but the brand platform, I guess they have branded products, is down massively. And their in-store gross merchandise volume is also down. Like, I can't really find one positive thing except maybe digital platform gross merchant value growth. But merchandise value growth. But Jim Cramer's right on this one, man. This is like clown stock level. So, I mean, you do what you want to do, man. You know, I'm sticking to VT with small speculative investments, but I'm definitely not putting $131,000 into this stock. But, you know, it's your choice, man. So, that's it. If you want a sponsored video, go ahead. You can send me $50. I'll do a sponsored video. This might be the best $50 you ever spent, boy. And I'll talk to you later.